All right, good morning. Tim and Travis here for talk number 7. It's been a while since we've been together, but we got a lot to talk to you about today. Want to wish everybody a Merry Christmas. We're coming up on Christmas. December tis the season, so hope all you guys have a happy holiday season. And let's just jump right into it and get caught up with talk 7. Travis, how you been doing?
Good. We've got, I think, 3 projects completed since the last time we met up, so excited to talk about those today. And we've got a big one in the works that we're going to hold off and hopefully talk about that in an upcoming episode that I'm very, very excited about. It's coming together really well. So we brought a couple other folks with us today that I think we should go ahead and kind of let them speak for themselves. Brian Zeiss has recently started helping us and working with us and is kind of interested in getting into kind of the real estate investment full time and what all that entails. And we wanted to kind of have him give some of his background and what brought him and got him interested in real estate. I've done some minor stuff with him in the past, but want to let him speak on the matter.
Sure. Thanks, Travis. Good morning. Happy to be here. Thank you all for having me. Just quick background on myself. I have a degree in finance, and I've worked in financial services for 16 plus years now. The majority of that time was spent on Wall Street as a high yield bond salesman. My real estate interest really peaked around while I was in college. Maybe a little cliche, but reading the book Rich Dad Poor Dad and really soaking up the concept of purchasing assets that then drive cash flow in order to fund your lifestyle rather than the other way around. So that concept resonated with me. Worked with Travis, like he said, a few years back. My wife and I started a company and did a couple of small flips while I was still working at the bank. And then, like you said, I've decided to do this full time. And really, I see, when I think about real estate versus other ways that we can invest our money, the idea that you can have some effect on a property and improve that property and have control over how those improvements are done is certainly appealing to me versus, in the equity or in the bond market where you're trusting, Wall Street analysts or some management team to kind of be good stewards of your capital. I just think there's more control in the real estate side.
And the other thing we kind of discussed about kind of hedging your downside on the contracts, like that, some of the long-term ones, if we get out 2 months, our worst case is kind of the EMD where we can kind of cut that loose. The way that you kind of saw that from a Wall Street perspective was interesting to me.
Yeah, I think that's fundamental. Every investor from Ben Graham to Warren Buffett to George Soros of today or anybody in between who's had a modicum of success on Wall Street will tell you that they are much more focused on capping their downside than they are on how much they have the potential to make. So anybody that has any longevity in volatile markets, especially like we've seen the last couple of weeks, if anybody's paid attention to what the Dow and the S&P have done, risk management becomes ultra important in times like this.
And so the way that we've done that, or we discussed that we can do that throughout real estate, when we go to purchase a property, I think we just contracted one on Wakefield. We've got a tenant moving out, and they're going to be moving out, I think, in mid-February. And so we went ahead and contracted on the property. We're risking our EMD, but here we are. We have a deal we think is really, really solid. But if we get 2.5 months out from now, and we find out that the market has just completely tanked, our downside's capped at our earnest money deposit, and we can walk away from that and say, okay, we've lost a relatively moderate amount versus being forward to go through it, or if you were to carry any type of a equities market through that, you don't necessarily have that kind of a hedge in your downside, which was an awesome thing that Brian pointed out to me. So awesome. Thank you. So glad you're here. And thanks. I'm super happy to have you on our team and working with you. You brought a lot to it. So what have you been up to, Tim?
So we've got a office full of people here today. We've got Alla with us today, and Alla is from Russia originally. She's had a great 2-year run here. She's from Myrtle Beach, so she wanted to sit in with us today and take a look at what we've been up to. We've got Hannah here today, who is our trusty get it all done girl. She's my personal assistant. I couldn't live without her. She's here, making it all happen on a day-to-day basis. So we're just going to do a little recap from our last talk, which was talk 6. We're now on talk 7. Our last talk, we were talking about being in the middle of a really big project that has since wrapped up. I finished my project up in the South Park part of Charlotte. The numbers roughly came in acquisition at about $660,000. We did rehab of 275-ish, maybe 280,000, and ended up contracting without it ever going on the market for 1.25. So that turned a really, really good profit. So in the past year, our two largest projects were an $880,000 sale and then a 1.25, which were both flips. I've just picked up today's paper and learned that in the second quarter in our market, the gross flipping profits were $65,000. And Travis and I talked about that, when you back out the costing on that, that's going to run you, you're going to end up with about a $20 to $25, maybe $30,000 profit. So, profits on flips are cutting down just a little bit.
But at the same time, make sure if you're relatively new to this and you pick up your local paper and you say, oh my gosh, look, people are making $65,000 on flips, realize that's not the case. They're getting that number HUD to HUD, meaning acquisition to sale price. They're not calculating for anything in the middle. No, general contracting work that was done, no electric bills were paid, no taxes were paid, no insurance was paid. So that's a very, very top line. So if you pick up a paper and read that number, don't get overly excited, although those are great numbers, even at the reduced and the reality of what the profits and the potential are is still very good. But if you're out there in the market already doing it, don't pick up that paper and get crazy discouraged and be like, oh my goodness, we must be the worst out there, because that's a HUD to HUD number.
No, so what we were doing is we were backing into the actual profit number. So on a deal like that where you're grossing $65,000 HUD to HUD, you're probably looking at anywhere from a $15,000 to $30,000 actual profit on a flip property. We've also been keeping a close eye on the economy. I'm getting real nervous. We've got a lot of property listed up right now. We're wholesaling some property because we want to have some dry gunpowder. The stock market, I'm sure, as all of you have watched recently, the past 60 days in the stock market's been going crazy. So we're trying to get positioned that if there's a downturn, we've got our rentals in place. And it's time to buy again if that happens. Travis, you got any opinions on that? Or Brian, do you have any opinions on that?
I do. I didn't know if we were going to cover that in this episode, though. But I guess now's better than time than ever. The rental properties last time in our market reduced about 30%, meaning that if your rental rates, if you're renting for about $1,000 a month, your rental would go to about $700 a month, is about what the market would bear. So traditional rentals are proverbial life rafts in this industry and in these turbulent times. I would caution against really high rents and really low rents, because if you're coming down 30% off of 500 rent, that tenant may be in a position that if they're that tight already, it's going to get very difficult for that tenant to even maintain. Then you're looking to re-rent a place in a downtrodden market. Also really high rents, if you're probably 2,500 and over, those are typically in people with more higher paying positions, which in downturn economies are, I don't want to use the word targeted, but when the company looks at a balance sheet, pigs get fat, hogs get slaughtered. Jim Cramer's clearly taught a lot of people that. So you want to make sure if you're going to go that route, in my opinion, you want to be in the meat of that curve. I would probably want to look for somewhere between that 1,250 to 1,750 marker, somewhere where that, the real median of your economy can still afford. So I think that is a solid life raft. And then I guess if we want to discuss Airbnbs, I think that's an interesting time to discuss that as well.
Yeah, one of the things that we were discussing, and one of the reasons we're getting to this point, is that we do feel like we may have a buying opportunity coming up. So in terms of completing some of the projects we're on and getting them retailed out and being in position to take advantage of possible downturns, we want to just comment a few on the projects that were wrapped up. The South Park project that I just spoke about, we're completely out of that. We had another big land position that we talked about in one of our earlier talks, where we went in and actually bought this property the second time. We've now closed out of that, and the numbers on that were staggering. We are now in the process of fixing up some of our long-term rentals in areas that properties have gone up dramatically. We're liquidating those to put some cash on the sidelines, and that kind of fits all into the economic thought that we may have a buying opportunity coming up shortly. So
I was talking about our thoughts on the discussions we've had about the Airbnbs and what we thought, kind of where they came out of, and what we thought they may or may not do in the next downtrodden cycle.
yeah, so the Airbnb and the short-term rental market, we've had alarming success with it. On average, I would say it's about triple revenue on the rental side. Is that what you're seeing?
Yeah, it's about 2.75% or somewhere. Yeah, we're real close to that is what we're seeing. But just to reiterate the point I was kind of getting to is the Airbnb industry as a whole really born out of the last recession. So we, or at least I am somewhat of the thought that it's likely that if and or when the next recession comes, that they're probably going to do quite well. When budgets get tighter, people are going to look for more cost-effective means to travel. And in the vast majority of cases, if you look at the cost of an Airbnb for the amount of bedrooms and bathrooms and kitchens that you get versus trying to stay in a hotel, you get a lot more for your money. So it somewhat remains to be seen, as we weren't fully operating in that model in the last recession. And it didn't really actually even exist. So we'll be interested to see how it does in the next downturn. But from that point of view, in my perspective, I think that that's going to be a reasonable place to be positioned for the next downturn. What were your thoughts on it?
So what we're experiencing, and you're probably the same thing, we are looking at somewhere close to 60% occupancy, which is where we currently are in the Charlotte market, maybe a little bit higher in the Columbia market. But at 60% occupancy, of course, there's less wear and tear on our assets. And it's generating, Travis has got the exact numbers, about 2.7 times actual rent. So it's going to be interesting to test that to see how those survive in a downturn. But I think Travis is exactly right. I think it's going to actually pick up business, because when economic times get tough, people try to find a more affordable way to travel with their families. And Airbnb's got to be one of the best ways to travel with your family that I've found.
Yeah, I would agree. Just the amount that you get for your dollar. I mean, you look at a hotel room for $175 a night, or an Airbnb that you get for $175 a night. And usually $175 a night in this market, you're probably getting either a really nice 3.2 or a 4.2.5 or something like that. It depends if you're looking at a professional Airbnb, or if you're looking at a mom and pop type shop. So, but when you go and look at what you get for $175 a night in this market in a hotel room, it's 2 queen beds and a bathroom with very little to no kitchen type amenities or anything of the nature. So it's certainly a lot more cost effective from that perspective.
And with us, 5 kids traveling, I mean, it is absolutely the best way to go. Just take my word on that one. We would have to get 3 hotel rooms between the boys, the girls, Shelby and I. So, when we travel, we're definitely looking at Airbnb for sure, or VRBO, short-term rental market. A lot of people don't understand the short-term rental market. We'll elaborate a little bit more on that later, but we're sold on it.
Yeah. So we're in episode 8. We're going to kind of give more of the numbers and the details on our other flip projects we had going on. We want to just kind of follow up and just reiterate. So we're kind of thinking the downturn market. We're thinking rental properties. We're thinking Airbnbs, and we're thinking we probably need to start thinking about getting some cash on the sidelines.
Absolutely. Try to lighten the load up on holdings that people are willing to pay you top dollar. My opinion was, if you're willing to pay me more than I would buy the same asset in today's market, I'm willing to take your money, and I'll sit back and be patient and wait for a chance to redeploy that. That's kind of where I'm thinking.
I mean, that's right back to Warren Buffett too, right? If we want to go back to the parallels with other markets in Wall Street, I mean, it's be greedy when others are fearful, and be fearful when others are greedy. And I think we've seen a lot of greed in a lot of different marketplaces and asset prices over, the last several years, really since the recession, with a few dips here and there. But it does feel to me, with the volatility we've seen lately, the prospect of rising interest rates, tensions on a geopolitical scale, it does feel like the time to be greedy might be coming to an end.
Yeah.
And one other thing that, and we're definitely going to discuss this in the next episode, wholesaling properties and the amount of reduction in risk it brings to your balance sheet in time and in capital. So get ready to go, guys. I'm excited about it. I'm going to follow up with episode 8 and kind of show you what we're doing to do that.
Yeah, so everybody stay tuned. We're going to come back, talk again on Talk 8. But, to wrap this talk up, what we're thinking, if you've got assets that you can liquidate at prices that people are willing to pay you today that you wouldn't redeploy at the same prices, take the money off the table, sit back, chill out, relax, and look for the opportunity. And we'll catch you up on the rest of our happenings recently in Talk 8. Hope you guys have a great day.
Talk soon.
Yeah.